Okay, well, let's stick with this theme of weak GDP in the second quarter and what it might mean for fixed income investors. Okay, we're joined by Bipan Rai, Managing Director and Head of ETF and Alternatives Strategy at BMO Global Asset Management. Great to see you.
Great to be here.
Your off-the-top reaction to the Q2 weakness, does it open the door wider to a possible rate cut?
Most likely, yes. I mean, we do think there's going to be at least one more rate cut this fall from the Bank of Canada. So, yes, the headline was weak, and we have to take that into context with what we saw in terms of a positive surprise for Q1. So if we compare where we are now relative to the end of 2024, we're tracking close to flat. But it's really the guts of the report that have us a bit concerned. Namely, the weakness came predominantly from trade, right? We know this from the fact that net exports were a significant contributor to the downside. Also, if we look at investment in machinery and equipment, a lot of that was tied to the lack of investment given the uncertainty with respect to trade. And we know from the Bank of Canada's prior statements that a lot hinges on the elasticity of demand in the U.S. when it comes to CAD exports. And again, that is going to be a problem area potentially to watch for. And again, if we look at some of the other details, final domestic demand was quite strong. But remember, that came in the backdrop of also households really dipping into their savings because the savings rate did decline. Also, we saw that compensation and incomes earned by households and also by the corporate sector as well, not quite as robust. So again, a final domestic demand profile that looks stronger in that backdrop to us isn't really the same thing. So again, it does make sense for the Bank of Canada to go at least one more time.
And what is final domestic demand? Just remind us.
No, it's a great question. I mean, it's one of those jargony terms that guys like me use and forget that we should probably contextualize it a bit more. So it's really just what we're doing in terms of the GDP calculation based on an expenditure approach. We're really tabulating the amount spent by households, firms, and the government, right? And then to get the GDP calculation, we also have to tie in the amount spent on inventories and net trade. So if we strip out net trade and sometimes even inventories as well, the final domestic demand calculation tells us what underlying demand in the economy looks like outside of the trade sector.
So it's not that bad in the latest quarter?
In the latest quarter, it wasn't bad at all. In fact, it expanded by 0.9% on the quarter. That corresponds to 3.5% on an annualized basis. So it's quite robust. But again, let's also keep in mind that in Q1, it wasn't really all that firm.
If somebody comes to you and you're at Costco and somebody comes up to you and says, Bipan, I love your stuff. Should I be buying 5-year Canadian government bonds now? My horizon is 5 years.
Right.
What would you say to them? Are they good value?
Well, so there's different ways to think about this, right? So on the one hand, you could say that the Bank of Canada potentially could cut interest rates one more time. And at the margin, that could be supportive for the front end of the curve. And some of that could also potentially seep in towards the longer dated issues, such as 5 and 10 years. But that's going to be offset in our opinion. And the big reason for that is the fact that we are going to get the spillover effect from the rise in term premium outside of Canada. Right, so
beg your pardon.
No, all good.
Term premium is a risk that investors see in owning bonds.
Right, it's the residual risk in owning the longer-term bond relative to the shorter-term bond.
Sorry, Bipan, go ahead.
All good. Okay. No, this is important to clarify. So generally, when we tend to see a rise in the term premium for longer-dated issues outside of Canada, in places like the United States, larger bond markets, we do tend to see a spillover effect that does matter for the domestic bond market here in Canada. So again, you're going to have two competing forces there. And at this point to us, I mean, fixed income really looks dicey as an investable asset class. And certainly not that great of a diversifier when it comes to portfolios relative to what we've seen over the past several decades. So that's one of the reasons why we made a bit reluctant when it comes to fixed income.
Alternative classes, what do we mean mostly? When you talk about alternative classes, what are you thinking about, Bipan?
Well, I guess the easiest way for me to sort of spell it out would be, allocations toward gold or even funds that track, say, infrastructure or private assets or let's say hedge fund strategies as well. We think those are going to be more and more used as diversifiers as opposed to bonds. So again, we could see this by the way that gold prices have moved over the last couple of years. Again, not a lot of that could be tied to the fact that you are seeing more and more of a rotation on the part of foreign central banks away from the U.S. dollar and into holding more gold as sort of a part of their savings profile. But on a go-forward basis, we also think that this is asset allocators allocating a little bit more towards products like gold as opposed to instead of using the old 60-40 approach and investing more on the fixed income front.
Leave us with a final thought. Investors will be, or are, we're hearing, putting more stuff into privately managed assets. The transparency is less, and sometimes you get funds telling investors, sorry, you can't have your money back for now, freezes. So it does seem that there is an extra type of risk with those assets.
There is. There is the liquidity risk that matters as well, right? So we encourage listeners and viewers of this to do their due diligence and not. I mean, the private space is incredibly vast and it's a big world to go into, and not everything looks the same. So again, private equity very different relative to private credit, and also different to infrastructure and some of the other potential alternatives there. But again, more and more what we're seeing is a greater amount of assets under management held by some of these funds, and we think that's going to be something that's going to continue.
What is your broad? Again, if somebody pesters you in Costco and asks, what do you think of crypto, Bipan? Are you interested? Oh, sorry, it's a very broad question. Yeah.
No, it's also an important question. And again, this is one of the reasons why I don't go to Costco as often as my wife would like. But, if we're talking about cryptos, it is part of the investable universe on a go-forward basis. And we are seeing greater and greater amounts of institutional acceptance, I should say, of the crypto market. Again, that is here to stay. Right. So, if we're looking at that as a diversifier, I still prefer gold relative to crypto. I just think gold has a far longer track record when it comes to institutional trust, and that'll stick around for a while. But can we see that rotation from gold into crypto? Usually, and that comes as part of increasing change in regulations, especially in the United States. And also, I tend to look at crypto as a macro strategist and economist, more as a longer-term hedge on what is happening on the monetary policy front, insofar as central bank balance sheets are concerned.
Bipan, thank you very much.
Thank you.
Bipan Rai, Managing Director and Head of ETF and Alternatives Strategy at BMO Global Asset